Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address is r.fxcm.com. Today is Thursday, and it's the 11th of August, 2022. I'm going to go ahead and bring up our high-risk investment warning. I'll keep this on screen, not big yours. This should read the 11th of August. So just, be aware of that. Hey Rob, morning to you. Nice to have you on the webinar as always. Thank you everyone for joining, much appreciated. And just bringing up the market commentaries disclaimer. Hey Sam, morning to you. Nice to have you on the webinar. And here's our references: Market Scope 2, CNBC.com, which we're going to read to start to kick off with, and TradingView.com. I'll just keep this on screen. I think obviously this is something we need to discuss. This is the core CPI. I'm just trying to reconcile the 6.04 here, but I think nevertheless we can still have a decent discussion around this. Hey Anna, morning to you, and thank you for joining. Nice to have you on the webinar as always. And let's go to the CNBC article, which reads: European markets mostly set to own higher after Wednesday's rally. European markets are mostly expected to nudge higher on Thursday as investors adjust their monetary policy expectations after a cooler than expected US inflation print. Britain's FTSE expected to slip. DAX looking to move 66 points higher, and CAC set to add around 32 points on open. Pan-European Stock 600 closed 1% higher on Wednesday on the back of a late rally as new data showed US consumer prices rose 8.5% annually in July, slowing from the previous month in large part due to a drop in oil prices. Economists had expected an 8.7% annual climb. The easing of inflation will inform the US Federal Reserve's monetary tightening trajectory ahead of its September meeting. Shares in Asia Pacific climbed overnight following rallies in Europe and on Wall Street. Hong Kong's tech-savvy Hang Seng Index led again. I beg your pardon, I'm going to read that again. Hong Kong's tech-savvy Hang Seng Index led gains as the tech sector benefited from the prospect of less aggressive interest rate hikes. US stock futures ticked higher in early pre-market trade as Wall Street looks to build on a surge that took the S&P 500 to its highest point since early May. We're going to see a fair amount of corporate earnings coming out of Europe, including Siemens, ThyssenKrupp, Bilfinger, Rabobank, MNG, Deutsche Telekom, and a host of others. Okay, I think it's worth saying right at the beginning, markets are so challenging, very, very challenging. I'm finding them challenging. So let's see if we can make some sense out of what's going on. And I think obviously the place to start would be with the inflation data that came out. This is the core number. So we've stripped out oil, we've stripped out food items, and there's no doubt it looks as if it's rolling over. Okay, so there's a potential turning point here, right? You know, sort of parabola. So here's your parabola. It looks like we're hitting that turning point and potentially coming down. And what we can do here is just add in our RSI. And what we want to do with the RSI here is put in a signal line. I feel that it does a fairly good job here of coinciding with the tops. Now we're just going to make this an exponential, and let's make it a 9. Okay, so we're looking for a crossover here. The RSI certainly converging towards that signal line. If I just click on the button here and click all of the data, we can go back to the last stagflationary periods just to get a view of what happened sort of in the early 70s. So here's the crossover, here's the core number coming down, and here is the second period, second oil crisis. There's the crossover and inflation coming down, and that might be the case here. The reason that why I say it might, because of course we don't want to get caught up in the time series bias. Each time period's got its own variables it's dealing with, but I would expect that if we get a crossover here, it's because core number is starting to come down. Rob says he's glad I'm finding it challenging. Gives it a lot of confidence. It's not just yet. Yeah, well, I think why it's challenging, Rob. So I'm actually glad that comment came out, because it's always going to be a challenge, always at a turning point, whether it's an uptrend into downtrend or from downtrend to uptrend. And I'm talking sort of on a primary basis. They're always going to be challenging. And Rob says he's glad it's finding it he's glad I'm finding it challenging because it's not just him then. So we're in the midst of this kind of I think turning point, and you can see that the core number is probably an indication of that turning point, right? If we go back, here's the turning point, here's the turning point, and we particularly at this turning point. What you should bear in mind, of course, is let's take out the RSI. Let's just add in producer price index here, because we're getting that today, right? So we saw, and I would expect moderation there as well, because oil's come down, food prices come down. Let's just throw the PPI on top of this as well. I'm not using core for PPI, okay? So using the headline number, but let's just throw it on. All right, so it's let me just see here. Yes, something's not right. That's better. Okay. All right, so let's change this to a just I think a easier color on the R's. I don't like this. Let's just make it sort of a nice royal blue. There we go. Even thicker. There we go. All right. So the PPI is our blue line, and the black line is our core CPI. Now, this is where it gets really interesting for our specific analysis, because I want to sort of marry this with the analysis we did a few months back. And what were we talking about? Well, we were talking about, well, when does PPI actually dip? When does PPI actually dip below the core? And I think that's also just helps with the whole topping out process. So you can see kind of here, the blue goes below the black line. This seems a bit odd to me, just there should be some sort of crossover here. I'm not sure what I'm doing wrong with the scaling, but nevertheless, point being, blue is under the black here, and we're kind of getting pretty close to that over here. You can see how the two series have converged. We're getting the PPI out today. Now, what would be interesting if we get a PPI, let's say we get a PPI at 10%, right? So it's currently reading at 11. Let's say it comes out at 10. Well, that's kind of the crossover below, right? That's kind of the crossover below. In other words, the supply shocks, so what's the point here? The supply shocks perhaps starting to moderate. Perhaps. This is all, you know, we're working with one data point. We haven't seen a trend. That's the difficulty of this. We're kind of stuck right on the cusp of, well, are we rolling over? Or is this just kind of a slowdown before we kick up again? And of course, I don't have the answer for that. Nobody has the answer for that, but I would suspect that there is a slowing down here because monetary policy is probably working along its transmission mechanisms, and we'll talk about that. I'm going to get an article out on that again. I'm still working on that, but it does look as if we might get the cross down here. So what we actually have the potential. Because I'm not sure that we've got the actual energy in motion yet, but the potential for the whole inflation story now to hit that turning point and come down. Now that's a big deal. That's a big deal because it flows directly onto monetary policy, and monetary policy flows directly onto time value of money calculations. So let's just make sure we understand there's still a certain amount of uncertainty here, but we don't want to hang on to our ideas. We want to try and be malleable, and we want to kind of flow in the direction of the information. The problem is we don't have sort of a trend of that information yet. The whole point being that if there is, and that's a capital I, capital F, if we get the rolling over of inflation, and I suspect we are, subject to correction, I suspect we are, then I think it comes down into monetary policy, and if it comes down into monetary policy, it comes into market mathematics. I don't want to get too caught up in the mathematics today, but I think it's time that we introduced it because we're going to have to talk about it as the story develops. The mathematics in of itself is not complex. We're not doing complex discounted cash flows yet, because I think the principles of just a simple time value calculation makes the point. And we've seen this now many times. We're working with something called present value. Okay, present value is effectively, this is where your price adjusts. This is price adjustment. Okay, so when we talk about present value, that's what the mathematicians call it. We talk about it as in terms of a price adjustment. And what we want to understand is that there is we'll just talk about it in terms of stock market because it will make the point. So cash flows from stock markets are called dividends. So our numerator is going to be a dividend. Okay. And then what tends to happen is that dividend, that's the numerator, so we have to put a divisor in, right? Assuming that my keyboard works, there we go. And then we're going to put in 1 plus, okay. Now, let's just not put in any funny letters here. Let's just put interest rates, just like that. Okay, and we're not even going to put we'll leave it as time period for over one period. In other words, I'm not putting any exponent here. So this is the function we're working with. It's good enough for us. It's going to make the point. It's going to make the point. So let's just start from the top and let's work our way down. Thanks, Sam. Okay, so Sam's just sent me I'll just pop this into the chat if anybody wants to check out the CPI data. Okay, just let me know if anybody didn't receive that. Anna's saying, why not call? Because, so she's going back to why am I not using core PPR? Because I want the volatile items. The volatile items, Anna, is what's I think is driving the consumer inflation. Oil's driving consumer energy. The volatility in food prices. So I think we're getting actually a better reading when we look at the producer side on a headline basis. Hey Howard, morning. Lovely to have you on the webinar. Welcome. Does that make sense, Anna? I think the core is much more useful on a consumer side, because we need to know the core, because that's what the central banks work with. We don't really need to know core on a producer price side. Okay, cool. All right, so now let's just draw a line here. Let's just draw. So going from this function here, we've got price adjustment. I'm just putting that on the left side, okay? And what we're going to put here is, let's just say our dividend's 100, okay? It's always easy to work with 100. And let's put this guy here. And we're going to put 1 plus, and let's just call it 10%. Now, what is 10% when you represent it as a percentage, sort of as a decimal? It's 0.1. Okay, that's what. So effectively, this is becoming 100 over 1.01. So if we just pop this into our calculator, okay, what you're going to get is 100 divided by 1.01, and you're going to get a price over here of roughly 99 bucks, if I've done my math correctly. Let me just pop that into my calculator and double check. Yeah. All right. Now let's just leave this for now. Okay. Let's just leave this for now. Let's go back to the conversation here. Here's our rolling over potentially of inflation. Again, the RSI, I think, is a good way to measure it in terms of is it crossing its signal line. Of course, we don't even have to use an RSI. I just think it's a really interesting way of looking at it. We can just put a moving average in the core number anyways. So you can kind of put in a 9-period moving average on this guy here. And we want to make it a exponential. Just make this 9-period, and we're going to make this one red. So you can see if we cross below if the black US core CPI crosses below its moving average. But the point being that, okay, if we get the moderation, now this is the key question. Okay, how's that going to adjust for our time value calculation? Well, we said it's going to happen in interest rates. So let's go now to the 3-year, because I'm using, sorry, not the 3-year, the 2-year, because it represents a good proxy for central bank policy. So I'm just changing now to US 2-year. Let's bring that up. Let's get rid of that guy. Get rid of that guy. All right. So here we've got the 2-year, and this is now very, very interesting. Let's go down to the daily. And what we want to see is how the 2-year yield is effectively going to adjust given the inflation data. I'm looking for this. Okay, so you can see we're in this range here. If we get into a situation that carries on moving interest rates up, okay, if we carry on moving interest rates up, okay, now this is a key point. Okay, I'm going to just go back to Microsoft Paint here. So what we're going to do then is we're going to I'm going to just change colors here, and we're going to say, well, if interest rate goes up from 10% to 20%, so let's just call it 1 plus 0.2, okay? So now we've got 100, okay, divided by 1.02, okay? Well, what's that going to give us in terms of our price adjustment? It's going to be 98. In other words, what's happened when interest rates go up, according to our sort of mathematics here, the price has come down. Okay, and that's effectively what's been going on for the first half of 2022. Now we've got a situation where it seems that we have a possibility of interest rates perhaps moderating. Why? Well, because we've kind of hit that turning point in inflation. And moderation perhaps kind of might be a little flatter. Okay, so you know, probably kind of like that. But the point is, let's go back to our, and we'll use a different here. Let's use this. Let's say that instead of 10%, let's say it goes down to 5%. So here we've got 1 plus, okay, 0.05, that's 5%. So now what you're going to do is you're going to take 1.005, divide that by 100, and invert it. Sorry, that's the way I do it. I'm a bit odd in my calculations, but so it's 100 divided by 1.005. And what you have now is you have 99.5. In other words, you've from 99, you've actually got 0.5 added on. How did we get that 0.5 added on? The adjustment's been made on your interest rate. Interest rates coming down, pushing price up. So what we've talked about here, I feel that maybe, you know, I'm getting a bit too long in this explanation. So let's just boil it down to this. 1, interest rates coming down will push present value, which is our price adjustment, up. Okay. Now this is the key. This over here is the key, because now we've got to ask the question: is this what's happening? Because if this is what's happening, that's a completely different paradigm from what we what was addressed in yesterday's webinar. In other words, we don't want to get stuck on old news. We want to be we want to bend with the new news. Again, the difficulty that I'm having is, are we actually moving from sort of downtrend to uptrend? And if we are, we need to move with that. We don't want to defend old positions. We don't want to fall in love with old positions. We want to move with new positions. But of course, the psychological aspect is we don't want to be trapped on the new position if the old paradigm is still in existence. It's a very, very tough market environment. And why is that? It's because I think we're stuck between sort of a potential transition period. But the whole point is interest rates coming down? Now, technically, we can make that argument if we go to the COPOP indicator. Okay, so if we go through to NASDAQ, we bring up FXCM's NASDAQ 100. What we want to do is we want to change this to the monthly. Okay, we want to add in the COPOP. COPOP's always used on the highest time frame. Again, I often get the question, can we use it on the lower time frame? I'm reluctant to do it. It wasn't designed for that. I've had academic arguments on technical bulletin boards about this. The point is you can use it, but just kind of test it out. My opinion is why kind of risk curve fitting here when you can use other indicators which probably do the job just as well? But I think where it excels, I think where the Copilot indicator excels is in what it was designed to do, which is effectively try and pick a bottom. I think it excels in that. Now, this is the conundrum of moving from one trend to another, is we only really are aware of the transition after the fact. Right now, it's pretty much guesswork. It's like, have we or haven't we transitioned? And I don't know. What we have with the NASDAQ COPOC is, of course, we have got the critical zero line crossed. That is essential. What we don't have is the turn up. Now, the turn up is everything. Okay, let's add in, I think, just a signal line here. Again, a signal line wasn't part of the original COPOC paper, but I don't see the harm of adding in a just a 3-period exponential just to help with the signal. Okay, that's fine. So a turn up here, I think, is okay. Would help. We don't have the turn up here, but of course you can see that the NASDAQ is absolutely climbing at the moment. That would make sense in terms of the COPOC theory, because we're getting early, but early is not at the bottom, right? In other words, we miss the bottom, and there is I think there's a good reason to perhaps accept that. It depends how aggressive you are as a trader. But I think that it makes a fair amount of sense to wait for the turn up. How come? Because you can get hurt quite badly if it turns out to be a false signal. And I refer to China 50 here, which you guys know is one that I've been tracking. But I think this is a good example here, in that the COPOC did shift up in June, but it looks like it's fallen back. So there's kind of a whipsaw signal, and perhaps the signal line here will help kind of control the whipsaw signal. So what's a whipsaw signal? It's kind of a false signal. China looked really good after the COPOC turned up after June ended, but you can see it's fallen back. Right. So has China bottomed? I don't know. What I can say, it's certainly in the value stage. It's certainly in the value stage. In other words, there's probably good companies there that you can start, keeping an eye on, assuming that's kind of a market that you feel you want to be involved. Some people don't want to be involved with it. Fair enough. The point is, as an educational tool, you can see that there was a sort of a whipsaw here, but we had a terrific May-June. Terrific May-June. Take that back to NASDAQ. Well, we've got a terrific July-August. So we've got a terrific July-August. The key is does that flow through to September, October, November, December? And the answer to that question is potentially it already depends on the price adjustment. So what we need to do is we need to see further alleviation on interest rate pressures. So any data that shows that the Fed needs to be less aggressive than initially communicated, I think does feed into the narrative that we may be near a bottom. Okay, so that's basically, I think, the answer is, well, we might be there, but I'm not sure. Let's keep watching. So how do we trade that? Well, it's very challenging, because trading now, I think we must understand we're in a potential Yeah, Sam. Sorry, I've just read your note. Yeah, I know core CPI is at 5.9. So that's what I'm saying. I couldn't quite marry it. I couldn't understand where that 6.04 is coming from. Maybe they're not, but exactly right. Yeah. All right, so let's talk about a couple of other things which I think are important. Sam says just try let's cut this ticker out. Oh, okay, core inflation rate. Okay, core inflation. Okay, so maybe this is what they're using as okay. I'll do some more work into that, Sam. But I think the idea is we're probably pretty close to that turning point. I think we can sort of get that takeaway. 3 conditions happening nearly. I think Gerdie is referring to NAS 100. By the way, Gerdie, what you're saying there is actually quite a big observation, because of course we're not talking about the 3 conditions on an hourly, daily, or even a weekly, right? We're talking about the 3 conditions on the monthly, which I did note. I did see that. The point being here that the 3 conditions are possibly very, how much if we've closed? We can make an argument that the 3 conditions have been made here. Yes, I guess that is one way to approach. Have we reached that market bottom? And if you want to use those 3 conditions on a monthly, I would see the logic in that. And you would probably get a quicker signal than using the COPOC. Again, like any technical indicator, we just need to not get too carried away, because of course, just going back to the China 50, we had the 3 conditions here as well, and I'm not sure if we're actually now getting the, so in other words, we might be getting a lower peak. So you might getting a low peak. So the 3 conditions are in the Nasdaq, 100% right. And if we are at a bottom, that's an extremely timely indicator. So it is worth just mentioning that. Let's go through to this here, which I think is still very. So now we're switching from sort of being analysts. Let's switch to being traders. It's so, and there's almost a divergence here. It's very difficult. Again, coming back to, I'm finding it a quite difficult market. Yesterday I made an observation that the real rates are actually looking like they're going to go higher. Now this kind of is contrary to what we've been discussing this morning. And how do we make sense of this? And I'll be honest, it's not very easy to make sense of this. What we have is a weekly. We're looking at the real rates here. We've still got our reference candle. Okay. Now the real rates reacted very strongly yesterday after the inflation data. I'm going to show you. They reacted very strongly, but all that reaction, that's been faded away. Now that's interesting. What is that telling us? And I don't have an answer for that, but I think it could potentially be important. We may not have cleared that turning point. So sorry to kind of throw this extra variable into the mix, but I think it's important. In other words, take a look at the hourly. Here is the CPI announcement. Here is the drop down in the real rates. That's been faded. Wow. Why would that have been faded? What is that telling us? Surely the interest rate trajectory must have been altered somehow. So we want to just keep an eye on that, keep an eye on the data that is affecting real interest rates, because what's going to be very difficult to pass out is a lower dollar with higher real rates. That for me is going to be very difficult to try and come up with some sort of fundamental reason for that. Clearly, if that's the way things are taking place, we would have to come up with something sensible and workable. But at the moment, it's kind of a very foggy area for me, because I would expect the correlation to be positive, not negative. So we want to keep an eye on the real interest rates. Again, if it moves up and starts its next leg up, I'm of the opinion that actually would work in the favor of the greenback. But then the question is, well, why would that be happening? Why would that be happening? Because we've seen the inflation data moderating. And there's only one sort of answer that I have to that at the moment. And I want to again tag on my subject to correction because I've got to think of it. But the quantitative tightening might still be working in the background. See, everybody is neglecting the fact that dollar money supply is being siphoned out of the system. And I think that that is a huge mistake, because it comes down to supply and demand. We all know that if the supply of something becomes scarcer, it makes whatever there is more valuable, okay? Assuming that whatever we're talking about has an intrinsic value, right? So the dollar still is potentially being supported here, and I need to see some data coming out in that regard. But the fact that the interest rates over here were actually supported, that for me was very, very interesting. Now, let's take a look at, sorry, not that, this. This is a crazy chart. So now this is the US dollar, and you guys can see the head and shoulders here. Now it's a daily time frame. I think it would be more important if there was a head and shoulders on the weekly time frame. But I don't want to just simply negate this head and shoulders on the daily. The fact of the matter is this headline is getting challenged, and the target down is 12,492 now. Again, I want to be very clear. Is 12,492 going to be hit? I mean, it might not. I don't know. It's purely just theoretical. The only practical application of a target is that it suggests that there is bearishness. I mean, we could go down, and then some data pushes real interest rates up, and the US dollar does a complete U-turn, negating this head and shoulders. But this is exactly what we're talking about. We're caught in the middle of this transition, and it's very difficult to kind of shift, or it is for me, from say a dollar bull to dollar bear. But it makes sense on one level. On one level, it looks as if inflation's moderating, but it's very difficult on another level, because, well, how's quantitative tightening going to affect this whole mix? And these are the variables we've got to try and make sense of. What it looks like is happening is that the market seems to be suggesting lower dollar prices ahead. Okay, that's what it looks to be. Now, this head and shoulders, we must keep an eye on. Again, I think that a weekly pattern would be much more meaningful. And just to draw a parallel, if we go back to the Euro US dollar, and we go through to our, if we go through to our weekly over here. Now I go back, here's the weekly head and shoulders on Euro, and Euro just got absolutely decimated following this. And this is just a complete change in trend. What we have would be a, now remember, this is the Euro on a weekly scale. So we've got a peak, okay, trough, okay, Here's the change in trend, lower peak, right? Now, as soon as we take out the lower trough, okay, as soon as that's the downtrend, and we can all see that effectively launched the capitulation of the euro. We don't have that on the dollar yet. So if we go through to the US dollar, we don't have a change in trend on the weekly. Okay, so the primary trend for the dollar hasn't shifted, but the daily certainly is indicating weakness. So how do we make sense of that? I think that there are immediate downside risks to the greenback, but I'm not convinced that there is an outright primary change in trend here because of the QT. Gerdie's asking, which is the bigger bazooka, QT or the interest rates? So I think, Gerdie, I mean, again, I'm going to tag on my subject to correcting, but I think QT is a big deal. It's literally taking money out of the market. Literally, it's kind of no longer available. That means whatever's left in the market must be more valuable. It just that's scarcity. So I think that, and think about it in terms of anything with intrinsic value. I mean, if we say, well, beach sand, obviously, okay, that's not going to work in this type of analysis. But if we say water on a hot day, the less of it, the more valuable it is, So and again, Anna's making the point that we haven't really hit that the trajectory of QT. Now, what we're mentioning here, when I say the trajectory, it's not right. We haven't hit the amount that they want to sell it per month, which is 95 billion. But it's coming. It's coming September. But we'll have to see how the market reacts. Now, where's that reaction going to take place for us to see? Well, I think it's the best place for us to watch it is with this guy. So if the real rates don't move up, if they kind of just move this way, or if they just move this way, well, then somehow, the rates, the constant rates, I think, do feed in negatively to the dollar. But of course, I don't know if that's the way it's going to. I feel that we just need to not lose sight that this QT is taking place in the background. With all that said and done, so what? What does that mean for us as traders? Well, again, it makes it very difficult for us to trade. So what we need to do, I think, is come back to a sensible approach, a systems approach, understanding now that risk management is everything. Why is risk management everything? It's always everything, right? But in times of uncertainty, that means there's times of high risk, then risk management must be everything. So let's go through to the dollar here. The dollar certainly in zone 3, okay? I think that the sentiment on the dollar is negative, okay? I think that it can change. I think it can change, but we've got this big topping pattern. We've got a zone 3. The crossover here, I think, is something that we can keep an eye on. And the crossover here, I think we can keep an eye on. And I think that the methodology that we use, we carry on using. And the whole idea is, do we hit the lower quintile or not? But you have a strict stop loss. Okay, let's go to take a look what's happening on the euro side of things. Okay, so euro now in zone 1. Okay, got the cross. As long as dollar sentiment suggests lower dollar, okay, that's going to be supportive of euro. But it all really depends on, do we make it to the 80 and hold? If we don't, then we don't. But we've got the crossovers here. So you can see that we go down now just to see where we positioned in terms of our zones. Follow the shorter term charts to see if there is any opportunities. Do I go along with it, or do I want to fade it? Understanding that we're at a potential transfer of one trend to the other. Always going to be tough, because what happens if that transfer doesn't take place? Hidden behind all of that, QT. So we want to watch that as well. Let's take a look at DAX just before we sign off. All right, so DAX is in zone 1. Okay, go down to the hourly, and you can see here is the hourly chart coming back down. Well, given the fact that we are in zone 1, I think that central pivot becomes a level that we can look at. In other words, do we get the opportunity of a 1, 2, 2, 3? Now, this to me, by the way, is uncomfortable trading, very uncomfortable trading, because why? It's very difficult to move from a bearish stance to a bullish stance, but we don't want to get sort of mired in the mud. Right? We want to be fluid. Must have strict emphasis on risk control. And just the last point again, understanding, okay, that there's still a lot here that needs to play out, so we can the analysis can adjust on a whim. Why is it sort of higgledy-piggledy? Is because we're stuck between trends. It's never easy when we're going to be stuck between trends, okay, because we don't know if it's a true trend change or not. This is kind of what's happening. Okay. So this is where we are. We're on this kind of red leg here. So I'll ask you, this is the question. Is this a trend change or not? How are we meant to know that? The answer is we don't know until after the fact. If we kind of get this, then yeah, it's a trend change. Okay. But if we get that, well then, yeah, well, then it's not a trend change. But we kind of, yeah. And that's a very uncomfortable place to be. All right, any questions? Any questions, guys? All right, let's wrap up here, and we will meet again tomorrow morning. Any questions? You have my email address. Thanks very much, guys.